Today we're going to be talking about Mortgage 101, the ultimate guide for our first-time homebuyers. There's so many things that go into the process of buying your first house, getting your first mortgage. Today we're going to talk about all of those things. First one has to do with planning your money.
I think a way to think about this is like if you're buying a house, there's good ways and bad ways of doing this. If you just kind of go in blind, you're going to get lost. Planning your money is going to be setting aside money for down payment and for closing costs. The first step is getting pre-approved and getting pre-qualified with your lender. We're going to set you on a path and put together a plan of attack for you kind of getting out there and knowing what you're going to qualify for and what you're going to be able to purchase.
Getting pre-approved is really important. It helps you understand what it is that you could be shopping for, what it is that you should be shopping for. And sometimes it's easy to get the whole like squirrel shiny like rock syndrome, right? Where you think that you know what it is that you should be spending every month with respect to like what the mortgage payment it is. But depending on who you talk to, the different type of lenders may try to push you up into spending more money than what you're like comfortable with. And so while getting pre-approved is really important, it's also very vitally important that you find a lender that you feel really comfortable working with. Comfort can mean a wide range of things. To us, it means that your loan officer is authentic, that they're considering your goals when you're having conversations with them, and finally, that they're going to answer any questions that you may have.
So let's talk about the timeline when it comes to buying a house and getting pre-approved. First step, talking to a lender. What we're going to do is we're going to take your information, we're going to look at your income, your credit score, credit report, look at your bank statement, see how much money you have set aside. We're going to put together a program that's going to best suit you for your needs. Once we have kind of an idea of what you qualify for, we're going to set up a time that we can have a conversation. That conversation is going to deep dive what your goals are, answer your questions, and get you on that path. Once we get an idea of what you are going to be doing, you're going to go out and you're going to start looking for houses. I always tell you, first thing, don't fall in love with the house until you're under contract. That's what an agent's job is. As you're out there looking, you're going to find a house you like. Hey man, we love this house, let's make an offer. Agent's job is to put together a good offer and a contract that's going to protect you during this process. They're going to submit that offer, and then based on your offer and the 10 other offers that might come in, the listing agent and the seller are going to find the one that best suits their needs. So if they don't take yours, don't take it personally. It didn't suit their needs. You got to go in with the best offer that you can make.
It's important that the real estate agent that you partner with also has a good working relationship with the lender.
So once you go under contract is when everything starts. That's when the application process starts with the lender, meaning we're going to have another conversation and we're going to deep dive. We're going to start getting all of your information, gathering your documents. You're going to be looking at your W-2s, your pay stubs, tax returns. Best thing you can do as you start this process is pre-gather that information. You're also going to be paying what's called earnest money. Earnest money is essentially you putting your money where your mouth is. Okay, it's going to be an initial upfront amount of money that's been kind of agreed upon between you and the seller that is going to basically tell the seller that, hey, I'm serious, hold on to this $3,000, and if I back away without a good reason, you get to keep it. Okay. Now, in the contract, there's a myriad of different things that allow you to walk away from that contract. If if the inspection's bad or doesn't appraise or you can't get the mortgage, there's certain milestones that you can hit to get your earnest money back. It's kind of a protection for you and the seller. That earnest money that you're putting in up front is eventually going to be used for your purchase. It's going to go towards your closing costs or your down payment. Okay, so it's, I'd count on seeing that money go towards something else. You're probably not going to see it again by the time you close. Meanwhile, on the backside, what we're doing is we've taken your information, we put together your loan application. We've sent you a full packet of loan disclosures. Okay, the loan disclosure is going to talk about the terms of the loan, how much it costs, all the things to expect. It's also going to be a bunch of paperwork that kind of is, saying we're not biased lenders. It's going to be a lot of federal disclosure things. It's important you read them, and it's also important that if you have any questions, you contact your loan officer and let them go through it with you. We're then going to take the information you provided us, your W-2s, your pay stubs, we're going to provide it to our processor. Really, I call them the brains of the operation. What their job is to take the information, make sure we did our job right in our pre-qualification and make sure everything matches up. They get the file ready for underwriting. Underwriting's job, they act as the gatekeeper. Their job is to make sure that loan that has been selected for you, that you meet those guidelines. Okay. They review the file, they make sure that our income works, our assets work, our W-2s are right, and they're making sure that there's going to be no problem getting your loan closed. Ultimately, they're the deciding factor when it comes to getting your loan done. As that's happening on the backside, On your side, you're going to get an inspection. It's really important that you find an inspector that is A, licensed, B, willing to crawl into the crawl space and get their hands dirty, and C, willing to answer your questions. It's a great opportunity for you to know how the house works, whether it's how do you turn off the water, how do you turn off the power, what kind of roof do you have. They're also going to give you a list of things that are wrong with the house. Inevitably, something's wrong with your house. That's just what happens. It becomes a then powerful document that then you can negotiate with your seller.
A good home inspector can honestly, at the end of the day, save you tens of thousands, sometimes even hundreds of thousands of dollars. The small amount that you would pay just to have your home inspector go and show you all the things, all the faults, if you will, all of the ugly areas of the house that maybe need a little bit of makeup, can help you either decide that you want to just disappear and not actually purchase that home, or put you in a position where you can use that documentation to go back to the seller and potentially ask them to fix a laundry list of the items that the home inspector discovered.
It's also your first out of your contract. So if you get an inspection done, let's say hypothetically the foundation's gone bad, you can cancel the contract and get your earnest money back. Once the inspection's done, we're going to order on our side something called the appraisal. The appraisal is different than the inspection. The appraisal is assessing what the value of the house is worth. So for example, let's say you're buying a $300,000 house. We ideally want that appraisal to come in at least $300,000. If it comes in higher, awesome. That means you're getting a good deal, okay?
Right.
If it comes in lower, there might be issues.
Issues with appraisals can vary greatly, and most notably speaking, they have to do with either the damage that's done to the house itself, or honestly, the seller's just listed it for like way too much money. In that moment, you have a chance to go back to the sellers and either renegotiate the sales contract price, or you can just decide to bring additional cash to the closing table to cover the distance in between what the appraisal was and how much the sales contract is, or you can just plumb decide to back out of the contract itself. The appraisal is really important though, as it shows you in this current moment in time how much the house is worth. The other reason why it's really important is that the loan associated to you being able to purchase the house is based upon the amount that the house appraises for. So if it appraises for short, then guess what? They're not going to give you a loan for the full sales contract amount. That's why you would need to bring some additional cash to the table. So if you're tied on down payment funds and the appraisal comes in short and you can't renegotiate the contract, then you still have an out at that moment to cancel the contract and get your earnest money back.
Once that appraisal is done, on the backside of what we're doing on the mortgage side is we're cleaning up all the file. We might come out of underwriting and the underwriter might say, hey, I need an additional W-2, or I might need clarification on this pay stub, or write me a letter about where you used to live. As we're gathering that information, our goal is to meet in the middle, have the appraisal arrive, have all of our documents in, and then be able to submit to the underwriter for what's called final approval. This entire time, we are talking to you. We're letting you know what's happening, we're keeping you abreast, we're here to answer your questions. It's really important though, on your side as the borrower, to work with us as a team. We only get there as fast as you operate. So the faster you work, the faster the lender works. Once we get the appraisal back and the underwriter has finished underwriting the file, they issue what's called a clear to close. Clear to close means we're done. That's the magic words that you want to hear. That's when I get to call you, or Ian gets to call you, or your lender gets to call you and say, we're done. Jump up and down, have a high five. But that doesn't mean go spend money yet. We're not through the process. The next step is going to be sending the documents from the lender to the title company. That's when we're going to see our final figures. The title company is going to be a third party associated with this mortgage. It's usually picked by the listing agent. Their job is twofold. Job number one, they're going to be issuing what's called title insurance. Title insurance is essentially an insurance policy that is taken out to make sure that there's nothing attached to the chain of title on your house. This will come into play if, hypothetically, the seller of the house hasn't paid their taxes in 10 years. The government can then slap a tax lien on that property. If you buy a house without clean title, that is now your lien. All right, so the title company is issuing a title insurance policy saying, this looks good. If anything pops up that we missed, we're paying for it. You're not paying for it.
An easy way to think about it is that title insurance is the only type of insurance that insures the past.
Yep.
All of the other types of insurances that we have, homeowners insurance, car insurance, they always insure the future.
They also then handle the transaction. They're in charge of disseminating the money at the closing table. So when we go to the closing table, meaning that we're all done, we've sent them our money, you've sent them your down payment money, we all go to the title company, they're going to present the documents, they're going to sign everything, and they're going to say, boom, you own a house, they jingle the keys, they give it to you, and then you're out the door, and you own a house.
Congratulations.
Congratulations, you own a house. Is our job done at that point? No. A good lender is going to make sure that they are in contact with you for the remainder of this mortgage. Our job continues to be to answer your questions. A year after you buy the house and you get your first tax bill in the mail, the inevitable thing you're going to do is freak out. And then you're going to call us and we're going to tell you it's okay. It's probably escrowed.
What does escrow mean, Brett?
Well, should we dive into that too? Should we dive into that? Okay. So let's talk about some Mortgage 101 stuff with your loan. With your loan, there are essentially 5 people to get paid, depending on the amount of money you put down. Let's just pretend you're putting down 5%. Okay. First people to get paid are the lender. They're getting paid the interest, which is the interest rate on your mortgage, and the principal, which is paying down your mortgage over the set amount of time, whether it's 10, 15, or 30 years. Second people to get paid is the government. They're going to be paid the property taxes on the house. Property taxes are associated with each individual property based on the county assessor for that individual property. So, it will vary. When we put together an estimate, we usually estimate high just to be safe. Mm-hmm. Third people to get paid are going to be the insurance company. Insurance company is going to be your homeowner's insurance. Homeowner's insurance is going to cover everything from fire to theft to all that fun stuff. You'll talk to an insurance company and you'll pick your insurance. And then the last people to get paid are the mortgage insurance company. In this scenario, you're putting down 5%. You're going to have something called mortgage insurance. What is mortgage insurance? It's different than homeowner's insurance. Mortgage insurance essentially is a insurance policy taken out by the lender to insure 20% of that money, to make sure that if you go into foreclosure, they're at least catching some of that money back. It's a policy that is taken out on your behalf, but ultimately it's for the lender. Sorry, you don't like mortgage insurance, put down more money. Is mortgage insurance a bad thing? No. If you get to keep extra money in your pocket and it makes financial sense, maybe you have mortgage insurance. So that's one of the things that we'll talk about in the planning of your loan.
As you can see, there's a ton of steps that are involved when you buy your first house. But what's important to remember is this. A good lender thinks of this moment as the beginning of the relationship and helping you manage that debt.